everybody, and welcome to the first episode of Beyond Death and Taxes, the podcast where we unpack the only two certainties in life, and we try to make one a whole lot easier to deal with.
We're your hosts. I'm Clay.
And I'm Matt, and we're part of the team here at Avalara. Every episode, we'll bring you insights on tax trends, regulatory shifts, and automation strategies that are shaping modern finance teams today.
Because while death may be inevitable, taxes as well. At Avalara, we're doing everything we can to ease the burden of tax compliance.
That's right, Clay, and we're super excited to kick the show off with everyone today. And what a better way to start than with a quick trip to the past.
And here we are, folks. Welcome to the Compliance Graveyard. This is our recurring segment where we're going to pay our respects to the tax and finance practices that are finally dead and buried.
And today's dearly departed? The Nexus guessing game. That wild era when finance teams would just guess what states that they owed money in and really just hope for the best.
Yeah, Matt, and you and I have been doing this for a while, my friend. Many times have we heard, we probably don't have Nexus there. And time again, those turn out to be famous last words.
That's right. Before Wayfair and economic thresholds, before real-time tracking tools, it was all absolute guesswork. And I've seen it time and time again. People using spreadsheets from the data that they had once downloaded and just kind of crossed their fingers and hoped that their method worked forever for them.
Good news. Those days are over. With the Nexus rules evolving fast, businesses need more than just hope if they are going to remain compliant, which is why we are officially putting an end to the Nexus guessing game.
That's right. Rest in peace. You will not be missed.
All right, Matt. Now that we've buried one old headache, let's talk about some new ones, specifically the latest and greatest tax changes that are impacting your business right now.
For sure, yeah. This episode is going to include highlights from Avalara's Midyear Tax Changes of 2025. This has been something that's been huge at Avalara and for our customers for as long as I've been here, so about 8 years. It's a roundup of the most important legislative and policy updates so far this year, from economic trends to digital compliance developments.
Yeah, I love it, Matt. And I think, you and I doing this for the past decade plus, we can attest to the fact that much has changed in only half a year. So tune into the mid-year changes. Whether you missed the live webinar or need a quick refresher, we have got you covered with everything that you and your tax team needs to know about the policies that have changed and are, changing coming up.
For sure. Well, that's enough of us. Let's just jump right into it.
Okay, I think the best place to start, I noticed that a lot of people are thinking about and paying attention to Nexus, which is always a good place to keep your eye on. And then secondly, the other poll question that ranked pretty high was the legislative activity and the way that it's changing these days. And the reason it's changing is pretty clear. Let's move right ahead, and I'm going to show you the state of the states. States have, in general, what we have here is the dark blue states look okay, short term. The light blue, they know they have problems. They're not in a panic mode. And orange is the panic mode, where expect to see legislative activity in the light blue states, the orange states, because we have to remember this is a closed environment, meaning the tax revenue that the states collect is their budget. So if they can collect more, they can spend more. And it's not in a malicious way. It's they can give their employees raises, they can get the latest equipment. So it's their job to make sure that they're continually looking at their flow of revenue. And that's why you're seeing so many legislative changes. Trust me, the states loved the Wayfair case because all of a sudden a bunch of companies had Nexus that have been doing business in their economic environment previously. But that's how we got to where we are right now.
Thanks, Brian. I think that's a really great segue into what we're seeing here. So like he just said, the states that are bright orange, those are the states we're expecting to see these legislative updates in, and that's exactly which states we're talking about today. So the big update in Maryland is this tax to data services, commonly being referred to as the tech tax. Some of you may remember back in 2021 when Maryland expanded its tax base to include software regardless of the method of delivery, and that included downloaded or software as a service. And then not too long after that, they kind of pulled back on it and added that exemption for commercial use in enterprise systems. Well, interestingly, what this change in the law does beginning in July is that commercial exemption from the regular sales tax still exists, but now for those items that are considered services instead of digital products for technology, you have this reduced 3% tax rate. Some of the other notable changes in this law is a lot of things that were previously not enumerated as taxable. Some data processing services, some of the information technology services are now subject to tax. And they also repealed the exemption for custom software and changes to canned software, customized changes to canned software. So a lot happening in Maryland. There are now very few exclusions that would not be subject to this 3% tax. It is important to note that it's either the state tax or this 3% tax, but not both. The other item to note is similar to the digital products and digital goods, how you have the ability to allocate based on multiple points of use. That extends to this new tax as well. So if you have users sitting all over the United States and not just in Maryland, it's something to keep in mind when thinking about what portion of your services or what you're buying is subject to tax. Next up, we have Washington. I left this taxing digital advertising here, even though if you asked Washington, they would say it's a tax on all advertising. However, there are some very notable carve-outs related to some of the traditional forms of advertising like radio, television, physical billboards. So a little bit of a discrepancy between digital advertising in my mind and some of the traditional not digital advertising, which raises a question of consistency between the two. And truthfully, beginning in October, it might be easier to ask what is not subject to tax in Washington, because this is a pretty broad scope that they've added here. We have temporary help services that are now subject to tax, custom website development, live training services. So whether they're digital or in person are going to be subject to tax beginning in October. A lot of changes. The other notable one is the data processing service, which there was that little carve out that was always pretty hard to figure out whether or not your service fell within it to begin with. That was excluded. That exclusion is no longer beginning in October. So it falls within the list of taxable services in retail sales moving forward. Some of the other states that are considering taxing services, so these are states that either had or still have some proposals out there to expand their tax base. Minnesota, what's notable there is a lot of professional services are coming into question. So that's your legal, accounting, brokerage, even some banking services are on the ballot. New Jersey, the most notable there for me was the participatory sports activities could be subject to tax. And then Nebraska, really not active anymore, and not even necessarily sales tax. They were talking about a wide consumption tax. That is not going to happen in 2025, but it was on the table, and it's an interesting way that they were hoping to gain more revenue.
You know, one thing that's interesting, Danielle, is in Washington, they've expanded to all these services, and people need to remember that this potentially, in most cases, is going to put you into a different B&O classification. The nice thing is you're going to go from maybe 10.5% down to 0.471. So you're going to, I guess that's the icing on the cake. I'm really not sure that's welcome news, but every little bit helps.
Yeah, absolutely. So some digital goods and software taxation continuation in the law, things that have gone into or have become effective over the last year or so. Louisiana, beginning in January of 2025, they began taxing digital goods such as information services and software as a service, regardless of the method of delivery. Helpful here, they do have an exemption in place, or a couple of exemptions in place for specific use. So if it's commercial use, really we're talking about business to business, there is still an exemption there for that. And there are exemptions depending on the type of purchaser, such as licensed healthcare facilities. Vermont, last year in July, about a year ago now, they enacted a bill to include pre-written computer software regardless of the method of delivery. So again, software as a service expanding into that area. And then some clarification of existing laws in Georgia and Texas with their regulations. Georgia's is interesting because they technically would tell you that they do not tax software as a service. However, what this regulation did was give us a little bit more detail on what the right to permanent use means and how that would be interpreted. So what they're saying in that regulation is if someone has the ability to download, say, a report or a video, even if the continued use of that is dependent on continued payment, that infers the right to permanent use if you have the ability to download that. So I think that was an interesting update. And then Texas clarifying that marketplace facilitator fees are taxable as data processing. And what I think is interesting about this is Texas was really pushing for this anyways. We saw it under audit for a few of our taxpayers. So it's nice that they're putting it out for other people before they come under audit to have an understanding of what Texas is going to be pushing for as well in the marketplace facilitator fees.
So being from Texas, I always like to remind people if you switch the vowels around, it does spell taxes. So, and they tend to want to tax everything. One particular note back on Louisiana, if you miss this, it's because they had a third extraordinary session that went from December 6th till about the 20th of the month, and they passed about 8 tax bills, and they made them all effective on January 1. So not only did taxpayers have to modify their systems to accommodate these new taxes, but local jurisdictions had to modify their returns so that you could file. And they expected everybody to get this done in like 2 weeks. So thank you very much, Louisiana legislature.
All right. Next up, we just have some updates on taxes on food, an area that we continue to see just a lot of ups and downs in. I think it's a political area. And so rate changes as well as eliminating the state sales tax on groceries in Arkansas, increases to the grocery tax credits, and some lower sales tax rates in certain states. Additionally, Illinois announced its amnesty program coming up this year. So from October 1st to November 15th, taxpayers will have the ability to enter into this tax amnesty program for relief on both penalties and to interest. Notably, there is also a remote seller specific sales tax amnesty program coming up next year. So this is not the only amnesty program that is, I want to say out there right now. I don't know how to word it. There are other states that have announced that they will have amnesty programs. We just don't have those dates yet. Indiana, I think Kentucky's been talking about theirs since 2022. Maybe this year's the year they finally make it happen. South Carolina. So waiting on some dates for these other amnesty programs, but there are a few more in the works.
I think what's interesting is Illinois has made some changes to its remote sellers regulations and laws. And I don't know if this is the right title for this. They might have been aiming to simplify the sales tax for remote sellers, but here's the new lay of the land. If you're a remote seller and have no physical presence in Illinois, you're shipping your product from out of state, they've switched to a destination sourcing rule. And the reason they're doing this is to more an impact not to the state so much, but more to local government. So you would be collecting now the state rate plus the local rate at your destination. The next category is for out-of-state sellers. So let's say you're in California, but you have a inventory in a warehouse in Chicago, and your fulfillment comes out of that inventory in state. In that case, you're going to use origin sourcing. So wherever you withdraw your inventory, you're going to be collecting that local rate. Again, the in-state retailers kind of staying the same. They're sticking to the origin sourcing, but that's Illinois' idea of simplifying something. So stay tuned. It'll probably change in a couple of years.
I'm also curious about how this hasn't been challenged more. Under this model, there is a chance for an out-of-state seller to have to apply a higher tax rate than an in-state seller, if it's destination-based versus origin-based. So I would think that would cause maybe an unfair advantage to someone who is in-state versus out-of-state.
Yeah, I think some Commerce Clause attorneys are going to latch onto this once the dust settles from the legislative session, and we'll probably, as you're indicating, see a couple court cases pop up.
And Illinois is not the only state that does it, but it's interesting to see.
Sure. Back to how do we make money appear in state treasury's bank account? And the best way to do it is to make more people subject to the tax. And therefore, when we see states adjusting their rules around the Wayfair case, most people, when they implemented Wayfair, followed the South Dakota test, 200,000 or 200 transactions or 200,000 in sales. There are states that are outside of that, but what we have seen is we have seen them notice that you could have one transaction that was just under the financial threshold and a ton of individual transactions or vice versa. And I guess what they're saying is the count really doesn't matter. It's more what is the volume of your activity. So you see a lot of states, Alaska, dropping theirs on January 1. Don't be fooled. Alaska doesn't have a state tax, but they have local borough, city taxes. And it is administered by the Remote Sellers Commission in Alaska. And they're very aggressive at reaching out to people shipping into Alaska. Somehow they seem to be finding out who those people are. I'm not sure how, maybe under audit. But they're being very aggressive. Utah is going to drop theirs, or did drop theirs. Illinois is coming up. They're going to drop theirs. And here's an interesting change. In Louisiana, they added some clarity into who is responsible for collecting the tax on accommodation intermediaries. And so this is under Act 82, and you can go out and read it. But it basically says if you're an Airbnb or a VRBO, that type of a facilitator of sales, then you are responsible for collecting the tax. They have carved out the mom and pops who, rent out a room in their house. They don't really meet the threshold or the criteria Louisiana's looking at. Any thoughts on this, Danielle?
Yeah. I would say just from a practical perspective, I can tell you I can count on one hand the number of times that a state has actually questioned a transaction count when looking to whether or not someone has triggered Nexus. At least in my experience with the taxpayers I worked with, it just proves to be a little bit burdensome on both ends. And to your point, they're looking for the dollars. It's the fruit isn't worth the squeeze if you have 200 transactions, but they add up to $50,000. And the states have gotten hip to that, and that's why we see that dropping so quickly across a lot of states. Louisiana, I think the other interesting update there is Louisiana has a long history of litigating these accommodation intermediaries, especially the ones for short-term rental facilitators. And one thing to note is, in addition to the sales tax change, this law also changes their responsibilities coming next year in 2026 to collect the local accommodation taxes as well. So speaking of broadening their revenue base, they're not just going after sales tax with these economic nexus laws and marketplace facilitator laws. They're going after other industry-specific local indirect tax types as well. So,
and what's really interesting is you see a lot of tax changes coming out of COVID that were, I would say, origined within COVID. Marketplace facilitators, everybody was ordering online and having things delivered to their doorstep. You know, even the director of the Department of Revenue saw it, the comptroller saw it, and then they thought, aha, how come I'm not taxing that fee? Because sometimes that fee can be significant, not significant in I'm going to buy a house, but significant in, $9 to $15. And if I could get the tax revenue for everybody who set a box on somebody's porch or a meal, that's additional revenue I want to get my hands on. And we're gonna stumble across a few more things that I say come out of the COVID regime, and it probably won't be surprising.
So yeah, looking at the economic nexus thresholds by state, this really just is an overview of what we already talked about. A lot of states, if you looked at this map in 2020, there would have been a lot more orange where we saw $100,000 or 200 transactions. Those states are peeling off and moving just to that simple dollar threshold. Every state that has a sales tax, and even some states that don't, if you talk about these other local taxes, have economic nexus. That is both for remote sellers and marketplace facilitators. So this is the state of the states. Do you have anything to add there, Brian?
No, I think it's a money grab, which we shouldn't be surprised. They're doing their job. And I think you're also going to see, when you're audited from the states aren't oblivious to AI, and they've started putting AI into their audit tools. So your audits are going to become a little more thorough, and that's just kind of a shot across the bow to keep your eye on legislation and keep your taxability updated on a regular basis.
Well, everybody, we appreciate you tuning in and listening. That's a wrap on this episode of Beyond Death and Taxes. We appreciate you guys joining us for the mid-year tax change rundown.
Good news and bad news, folks. The good news is, if you enjoyed today, there will be much more to come, because the bad news is this is inevitable and insanely complex, and it matters to most people out there that are conducting business of all shapes and sizes. So if you did find this insightful, just wait. This is only the beginning. We've got expert takes, automation strategies, and a real talk on the future of tax compliance coming your way.
And of course, Clay, many more stops with you in the compliance graveyard.
Yeah, that's right, Matt. First of our many trips to the graveyard. Be sure to follow and subscribe wherever you get your podcasts so that you never miss an episode. If you liked what you heard, please share it with a fellow finance professional, the kind who'd appreciate being just a little bit more prepared.
That's right. And for any more resources that you guys may need, or any updates and the full mid-year tax webinar, head to avalara.com or check out the link in the episode's notes below.
And guys, until next time, you stay compliant out there.